Hey everybody, welcome back to the show. So it's April 7th at about 8 a.m. in the morning. The market hasn't opened yet, but stock futures tell us the market's going to drop again today, as it did pretty significantly last Thursday and Friday, all triggered by the tariffs that President Trump imposed last week. And so what I thought I would do in this video is walk through 7 things you might consider doing or not doing during this. I think we can fairly call it a market crash. Number 7, by the way, is just a sort of a high-level view of what I'm doing and not doing, but I'll walk through them one at a time. And just to put all of this in perspective, before we get to the 7 things, this is the futures as it's 8:02 in the morning. The Dow's is projected to be down about 2.27%, S&P 263. NASDAQ almost 3%. So the market is definitely, at least at the moment, slated to fall pretty significantly. And that, of course, is on top of about a 10% decline at the end of last week. So what do we do? And so seven ideas. Again, I'll kind of mention what I do at the end. But number 1, I do remind myself that I'm not very good at predicting the future when it comes to the economy, markets, and so on. I think when we look at something like the tariffs, I think we can reasonably predict that if they stay in place, they will, among other things, increase the cost of things that we buy. It's sort of, I think we can probably predict that pretty safely. It gets harder to predict, though, exactly how much goods and services will go up, and specifically the things that we buy. And that gets complicated for a lot of reasons. We don't know how much the manufacturers will eat those costs, retailers will eat those costs, even countries necessarily. But I do think it's safe to say prices will go up. But what we don't know is how long will the tariffs stay in place? What is President Trump thinking? Is this just a negotiating tactic, and maybe they won't remain in place very long? Will he exempt a lot of products and services from these tariffs? Or, we don't know, could they stay in place for a long time, at least perhaps through the end of his presidency? The point is, there's a lot that we don't know and a lot that really is impossible to predict. And I remind myself of that when we're going through volatile times. By the way, I remind myself of that during the quote-unquote good times as well, when the market seems to go up 1 or 2 or 3% a day. I remind myself then, Rob, you're not good at predicting the future, and you shouldn't invest and make investing decisions as if you are good at predicting the future. So that's the first thing. I remind myself the future is pretty uncertain. I'm not good at predicting it. All right. The second thing is perspective. And let me show you what I mean by perspective. We often get very focused on what's happening right now. Stocks down last week, look like they're going to be down again today. And but I like to sort of zoom out and take a broader perspective. Let me show you this. This is just the Apple Stock app. We're looking at the S&P 500. We're looking at a 1-week view, obviously in the red, down 7.84%. Actually, if we measured it from when they dropped on Thursday, it's closer to 10%. And it's easy to sort of focus only on this. But as we zoom out a bit, we go to 1 month, it's actually worse, down 12%. But we go to 3 months, down 15%, still getting worse. 6 months, it's down 11%. But then if we go out to 1 year, well, okay, it's only down 2.5%. That's probably not the kind of number that would get us too excited. If we go out 2 years, it's actually up 24%. And we could keep doing this. Of course, the further we go out, 5 years, it's up 81%. 10 years, it's up 141%. I like to zoom out and look at this from a bigger perspective than just what's going on now. And of course, we could do that with other things, individual stocks or funds that you own. We could look at VTI, which is a total market portfolio. It's down 339 over the last year, but up 22% over the last 2 years. And so taking this sort of a broader view, I think, helps put things in perspective, because we're not investors for a day or a week or a month or even a year. We're investors for decades. And even if you're like me, in or near retirement, even say you've just retired and this happens, yeah, goodness, what a terrible time to retire. and let's say you're 65, the vast majority of your money is long-term money. You're not going to spend it all in year one. You're not going to even spend much of it at all. Maybe 2, 3, 4% of it, perhaps, maybe 5%, but the vast majority of it is still long-term. And assuming, a retirement plan of 30 years, you're still very much a long-term investor. And I like to remind myself to zoom out and take that long-term perspective. So, having said that, number 3 is I think it's worthwhile to take a look at your asset allocation from a couple of perspectives. And let me show you one tool that I've used for a long time to do that. It's called Empower. We've talked about it on the show before. This is a demo account that I use to show you all. And I've just put in what is effectively a 3-fund portfolio. But the thing I like about Empower, first of all, we can look at our balances. You can see it's an, I call it in a Roth IRA, but it's again a 3-fund portfolio. It owns BND, which is a bond fund, VTI, Total U.S. Stock Market Fund, and VXUS, an international fund. But a couple of things I like about Empower. One is it gives you a clear picture of your performance. Now, this fund over the last 90 days is down 7% compared to the S&P down 14%. And that's sort of the point I want to make. Particularly if you're in or near retirement, I'm assuming you have a fair amount in fixed income. Now, in this case, we can look at the holdings. It's roughly a 70-30 portfolio. It's come down because the stock market has come down, particularly VTI and VXUS. So it's not quite at 30%. And that gets me to the second thing I really like about Empower is we can look at the allocation. We can see, I guess bonds are, but I tried to do the calculation in my head, didn't do very well. Bonds are roughly about 30% of this portfolio. And you can break that down. If we click in, it can show you, government bonds versus corporate bonds, and it can do the same thing with stocks. But I think it's important in difficult times like this to say, okay, wait a minute, what's my asset allocation? Is it part of my plan? Is this where I want to be? And the other thing I like to do, particularly if you're in or near retirement, is to say, okay, percentages are great, but what's the actual dollar amount of my fixed income? I would include bonds and things you might describe as cash. And I like to ask, all right, how long could I live on that if I had to? Now, I don't personally follow what's called the bucket strategy. I'm not going to just spend down my cash and then my bonds and leave my stocks alone. That would effectively be saying I'm not going to rebalance for a period of time. We'll talk about that in just a minute. You may follow the bucket strategy, fine. But the point is, whether you follow it or not, how much do you have in fixed income and cash, and how long could you live on that if you had to? And I did that this morning. I looked at the number. It gave me some comfort. We could live a fairly long time, say greater than 10 years, on just our fixed income and cash if we had to. And that's one way so just psychologically, it helps me weather difficult market times like what we're having now. So I think number 3, looking at your asset allocation. You don't have to use a tool like Empower, by the way. It just makes it easier, but you can do it by hand. You could calculate it in a spreadsheet if you wanted to. And then ask on the fixed income side, how long could we live on that? I think particularly for those in or near retirement, that is can be a big advantage. Now, number 4, cut expenses. I actually think we should generally be looking at our expenses all the time, not just when the market crashes. But I think it's fair, particularly because of why the market's crashing, right? The tariffs effectively are a tax. These new tariffs basically represent a pretty significant increase in taxes, frankly, on the world, but certainly on U.S. consumers and U.S. businesses. We are now going to pay more. We might not know exactly how much yet, but we're going to pay more for the things that we buy. By the way, I won't get into the details, but that could include things that are manufactured here in the United States, not just things that are brought in from other countries. I think given those circumstances, it makes sense to take a hard look at what we're spending and make some cuts. One of the apps I use, you certainly don't have to use it, is Rocket Money. And one of the features I like about Rocket Money, I'll show it to you now, is they have this recurring feature where it will show you your recurring expenses, think subscriptions and whatnot. In fact, it shows you not only your monthly subscriptions, but like take a look at Calendly. This was a tool I used to use for my business. It's an annual subscription, so it's easy to forget about. But what Rocket Money does is it marks it as annual. It tells me when it's going to be due. I've already canceled this subscription. By the way, I canceled it about a week ago before the tariffs were announced, just because I'm not using it. A great tool, by the way. I'm just not using it. But I like this about Rocket Money, that it shows you your recurring expenses. And I've gone through here recently, as in this past weekend, and found a number of subscriptions that we're just not using. I've canceled them. You can even look at a calendar view, which I think is great. And so again, you don't need Rocket Money. It's just one of the budgeting apps that does this. I think it does it exceptionally well, because it started out as an app called Truebill as a subscription manager. So that's sort of how it started. It's now called Rocket Money. So it's what I use, but you could use just about any budgeting app, not all of them, but most of them will show you your recurring expenses. And I'll leave links to that as well as in Power below the video. But the other thing I'm looking at are some bigger purchases that we had planned. I might put them off to sort of see how the tariffs and the market shakes out. And so I think that's a reasonable reaction, frankly, to any market crash. I think it's a natural reaction, but certainly one driven by what is effectively a pretty significant tax on everything, virtually everything, that we might buy. I think it makes a lot of sense to scrub your budget, and it might give you more comfort in weathering the storm. All right, so that's cut expenses. That's number 4. Number 5, we're going to look at number 5 and 6 kind of together. Number 5 would be, hey, we could just sell stocks. And number 6 is going to be, we could buy stocks. Yeah, totally different. Let's think of these things through. So one option would be, Rob, I'm scared of what's going on. The market's going down. I'm out. I'm going to sell stocks. Now, that is not an approach that I have taken in the past. And I've invested through the tech bubble crash, the Great Recession, COVID, now the Trump tariffs, which I'm sure we'll be talking about literally for decades to come. I imagine doing a video, I don't know, 10 years from now, if I'm still doing this, and I'll sort of reel off all of the bad markets that we've had. And it'll include the tech bubble, and it'll include the Great Recession and COVID and the Trump tariffs. That they will become part of the history of the stock market for years to come, in my view. We'll see how bad it gets. But I am not selling stocks today any more than I did in those past difficult environments. And part of the reason, it goes back to the very first thing I said at the start of this video, is I am really bad at predicting the future. I can certainly predict some things with some degree of confidence, like if the tariffs stay in place, prices will go up. I think that's pretty straightforward. But the key to that is tariffs stay in place. There aren't exemptions for them. And those are things that I just don't know. I don't know what's going to happen with tariffs. And even if they stay in place, eventually the market will sort of reach an equilibrium, if you will. It will have fully factored in those tariffs, and it will stop falling. I don't know when that is either. And there might even be times when it starts to go back up as consumers and businesses adjust to the quote-unquote new normal. I don't know when that's going to happen. There's so much that I don't know that keeps me from trying to time the market in a way by going in and out of stocks. The other thing is, if I were to sell stocks or stock funds now, I'd have to decide, how much am I going to sell? Am I going to get completely out? And then I'm going to have to decide, at what point do I get back in? And I've just found that I'm not good at timing those things, and that long term, I am much better off leaving everything alone. Now, having said that, if you said, Rob, appreciate that, but I'm selling stocks, I would suggest you keep a couple of things in mind. First of all, I would be very careful about triggering a lot of taxes if you're selling inside a taxable account, which is what we would have to do if we were going to sell all of our stocks. And it would trigger a lot in taxes because I'm a long-term investor. We have a lot of built-in, unrealized capital gains over what's now decades of investing. It would be a huge tax bill. And so I would caution against triggering a tax bill as you head to the exits. At least factor in what that's going to be so that you know what that's going to look like come tax time before you make any decisions. The second thing I would say is, if you just feel a need to sell something, I would sell as little as possible. figure out what you need to do to sleep at night. If that's what you need to do, that's what you need to do. But I would try to minimize it as much as possible. Again, because I think it's so difficult to predict the future. So if you're going to sell, I would try to limit it to retirement accounts where there's not a tax consequence unless you have some losses you can offset the gains against. And I would try to make the smallest changes I could in order to feel comfortable. Now, that kind of gets us to the idea of buying stocks, because one option that sort of bridges all of this is rebalancing and the right asset allocation. So you might look at your investments and say, Rob, I was just too stock heavy. I knew I was just kind of enjoying the ride up, and that was my mistake. And I really need to set a more realistic long-term asset allocation, which includes more fixed income than I had. I get that. I generally try to avoid making changes to my asset allocation when the market is volatile. And that could be bad markets, like when the market's down now. Also good markets, when the market's just flying high, because I'm concerned that my emotions will be driving the decision to change my asset allocation. And so I try to avoid those times. But maybe you're in a situation where you say, Rob, I really had not the best asset allocation. I've got to make a change. All right, you can make that choice. And maybe changing that asset allocation will require you to sell some stocks, even with the fact that they've fallen so much. The thing, again, though, you got to recognize that you're doing that in volatile times. Is it driven by emotions? Only you can answer that question, but I think it's worth thinking about and getting to an asset allocation that you can live with in good times and in bad. That gets back to looking at your fixed income, as we talked about earlier, and understanding how long you could live off of that if you had to. I think that helps us get a real good sense if we're at the right asset allocation, given wherever we are in our investing journey. But once you have the right asset allocation, one idea is to actually buy stocks by rebalancing, right? And now, should you rebalance now or should you wait? Again, I like to make those decisions when the market is not falling or rising. So in our case, I generally rebalance once we get outside of a range of a certain asset allocation. In our case, our overall stock buying allocation is 75-25. I generally let it move within a pretty wide range of plus or minus 5%. So I'm generally not going to rebalance unless it falls, in this case, below 70% stocks and 30% bonds, and it hasn't done that yet. It might. We'll see how far it falls. In that case, that would trigger rebalancing. And so, yeah, I would be buying stocks in that case and selling bonds. But I set that sort of rebalancing rule a while ago, before stocks fell like they did last week. And so I know that it wasn't an emotionally driven decision. In your case, maybe you just rebalance once a year. Come December, you rebalance. In that case, that's your plan, that's your rule. You may or may not need to rebalance come December. We don't know what the market's going to do. But whatever that plan is, I follow it. And so that may make me a buyer of stocks, depending on just how far stocks fall. Now, if you invest in individual companies, now may or may not be the time to invest. I'm not a big believer in, quote, buying the dip, because we don't know if we're in the dip or not. We have no idea if stocks, we know they're probably going to fall today. Is that the bottom? They're going to go back up after that. So this is the dip. We just don't know. I think you can evaluate a company and make your own assessment as to whether it's a good buy now. Having said that, I would say, given the uncertainties that the tariffs have introduced into the world economy, I think it gets pretty tricky to evaluate whether something's a good buy now. Whether you think you can do that or not, I'll leave that to you. I can tell you right now, I'm not buying individual stocks. I will buy stock funds if our asset allocation, as I mentioned, falls below the range that would trigger rebalancing. I'll follow that rule and I will rebalance. Okay, so at the end of the day, what am I doing? I'm not selling out of fear. I've not sold anything at this point. I am keeping a long-term perspective. I'm looking at not just stocks this week or this month or even this year, but longer term. And also, I'm recognizing that even though I'm a bit older, maybe than many of you watching this, I'm still a long-term investor, and I suspect we'll look back on this as just one of the many blips, I guess we'll call it, that we've gone through as investors over the last many decades. That's my take on it. I guess time will tell. I will rebalance, as I said, if my rebalancing plan is triggered. It hasn't yet, but who knows? After today, maybe it will be. And I follow the financial news carefully, but maybe it's best that you don't. Maybe it's good to just turn it off and not look at your portfolio. I think that is an absolutely reasonable choice to make as well. So that's my take. I think there are some productive things we can be doing, but by and large, I think panic selling would be about the worst thing one could do generally in market turmoil. At least that's my take. If you have any questions, or maybe you see this very differently, I'd love to hear about it. Leave them in the comments below. And of course, as always, I'll be happy to help you out any way I can. I'll be checking the comments and responding as well. So there you go. Until next time, remember, the best thing money can buy, even in these difficult times, is financial freedom.